Hello everyone. So in this video, I am going to share some most important ways you can become financially independent and understand the personal finance basics. For better understanding, I will be listing all of them right here. Let's go ahead and get started with this video. Make sure to subscribe to this channel if you want to see more such videos like this. So before proceeding further, let's understand what is personal finance. Personal finance is where financial literacy translates into individual financial decision making, and it will help you answer few questions such as how do you manage your money, which savings and investment vehicle which you should be using. Is personal finance about making and meeting your personal financial goals? Whether you are owning a home, whether you are helping other family of your members, saving for your children's college education, supporting causes that you care about, planning for retirement or anything else. Among other topics, it encompasses banking, budgeting, handling debt and credit, and investing. Let's take a look at these basics to get you started. First, introduction to bank account. It is a must for everybody to have a bank account. It's a basic criteria for someone to get into the financial inclusion. Bank accounts are typically the first financial account that you will open and are necessary for major purchases and life events. Here, I will be breaking down of which bank account you should consider and why these are step 1 in creating a stable financial future. The very first question that must be answered is why do I need a bank account? Though the majority of people around the world have bank account, but still in this era of internet connectivity, metaverse and all about cryptocurrencies, there are some who are marginalized with even this. 6% of the household in the United States still don't have one. Whereas in India, which is a developing country, it has 20% of the population who still do not have a bank account. Now the question arises, why is it so much important to have a bank account? And the answer to this is because it is safer than holding a cash. Assets held in bank are harder to steal. And in all countries around the world, they are generally insured by the top bank regulators of their respective countries. Example, in the United States, it is done by the Federal Deposit Insurance Corporation, which is known as FDIC, and in India, it is done by the RBI, which is the Reserve Bank of India. This means that you will always have access to cash, even if every customer decided to withdraw their money at the same time. Many financial transactions require you to have a bank account. Example, using a debit card or a credit card, use Paytm apps like Venmo or PayPal, writing a check, using an ATM, buying or renting a home, receiving your paycheck from your employer, earning interest on your money. Now, there are two types of banks where you can open your bank account. Number 1 is online and number 2 is brick and mortar banks. Now, let's understand online and brick and mortar banks. When you think of a bank, you probably picture a building. This is called brick and mortar bank. Many brick and mortar bank also allows you to open accounts and manage your money online. Some banks are only online and have no physical buildings. These banks typically offer the same services as brick and mortar banks aside from the ability to visit them in person. The next very question arises that which type of bank can I use? So the answer to this is retail banks. This is the most common type of bank at which people have account. Retail banks are for profit companies that offer checking and savings accounts, even loan accounts and credit cards and insurance they also provide. Retail banks can have physical in-person buildings that you can visit or be online. Most have both. Online technology tends to be advanced and they often have more locations and ATMs nationwide than credit unions do. You must have heard about credit unions. Credit unions provide saving and checking account. They issue loan and also have other financial products such as banks do. The question now arises, which type of bank should I open? There are 3 main types of bank account that the average person may want to open. The first is saving account. A saving account is an interest-bearing deposit account held at a bank or other financial institutions. Saving account typically pay a low rate of interest, but their safety and reliability makes them a sensible option for saving, available for cash and for short-term needs. They usually have some legal limitation on how often you can withdraw money, but they are generally very flexible, so they are ideal for building an emergency fund, saving for a short-term goal, or like buying a car or going on a vacation, or simply storing extra cash that you don't need in your checking account. Number 2 will be current account. A current account is also a deposit account at a bank or other financial institutions that allows you to make deposits and withdrawals. Current accounts are very liquid in nature, meaning that they allow numerous withdrawal monthly plans as opposed to the less liquid saving or investment accounts, though they earn little or no interest. Money can can be deposited at banks and ATMs through direct deposit or through another type of electronic transfer. Account holders can withdraw funds via bank and ATMs by writing checks or using debit card linked to their account. You may be able to find a checking account with no fee. Others have monthly and other charges such as overdraft fee or using an out-of-network ATM. Based on the example, how much you keep in the account, that also matters, whether there is a direct deposit paycheck or automatic withdrawal mortgage payment connected to the account. Number third is high yield saving account. A high yield saving account is another type of saving account that usually pays a much higher rate of interest than a standard saving account. The trade-off for earning more interest on your money is that high yield account tends to require bigger initial deposit, larger minimum balances, and higher fees. Let's talk about emergency fund. An emergency fund is not a specific type of bank account but can be any source of cash that you have saved to help you handle your financial hardships like job losses, medical bills, or car repairs. How does emergency fund work? Most people use a separate saving account. The account should total enough to cover 3 to 6 months of expenses. Emergency fund money should be off limits for paying regular expenses. Now let's move to introduction of credit card. You know them as the plastic cards that almost everyone carries in their wallet these days. Credit cards are accounts that let you borrow money from the credit card issuer and pay it back over time. For every month when you don't pay back the money in full, you will be charged interest on your remaining balances. Note that there are some credit cards which are called as charge cards which require you to pay a balance in full each month. However, these are less common. Some may ask, what is the difference between credit and debit card? Here is the difference. Debit card take money directly out of your checking account. You can't borrow money with their debit card, which means that you can't spend more cash than what you have in the bank. And debit card don't help you build up a credit history and credit rating. Credit card allows you to borrow money and do not pull cash from your bank account. This can be helpful for large, unexpected purchases, but carrying a balance, not paying back in full the money you borrowed every month means that you will owe interest to the credit card issuer. So be careful about spending more money than what you have because debt can build up quickly like a snowball over time. On the other hand, using a credit card judiciously and paying your credit card on time help you establish a credit history and a good credit rating. It is important to build a good credit rating not only to qualify for the best credit cards but also because you will get more favorable interest rates like on car loans, on personal loans, even on mortgages. Now let's understand what is APR. APR stands for annual percentage rate. This is the amount of interest that you will owe to the credit card issuer on any unpaid balance. You will want to pay close attention to this number when you apply for a credit card. A higher number can cost you hundreds or even thousands of money if you carry a large balance over time. The average APR today is about 20%, but your rate may be higher if you have a bad credit interest rate and also tends to vary on the type of credit card. Now the question might arise, which credit card should I choose? Credit scores have a big impact on your odds and getting approved for a credit card. Understanding what range your score falls into can help you narrow the options as you decide on the card for which you may apply. Beyond your credit score, you will also need to decide which perks best suit you, like your lifestyle and spending habits. If you have never had a credit card before or if you have a very bad credit, then you will likely need to apply for either a secured credit card or a subprime credit card. By using one of these and paying back on time, you can raise your credit score and earn the right to credit at a better rates. If you have a fair to good credit, you can choose a variety of credit cards such as travel reward cards. These credit cards offer points for say travel purpose including flights, hotels, rental cars with each dollar you spend. Number 2 can be cashback cards. If you don't travel often or don't want to deal with converting points into real life perks such as a cashback card might be the best fit for you. Every month you will receive a small portion of your spending back in cash as a credit to your statement. Third type can be balance transfer card. Balance transfer is also a facility which are available in credit card. If you have balances on other cards with higher interest rates, transferring your balance to a lower rate credit card could save you money and help your credit score. Some cards are also known as low or no APR cards. If you routinely carry a balance from month to month, switching to a credit card with a low or no APR could have you hundreds of dollars per year interest payments. You must have a thorough research credit opportunities and available interest rates and be sure that you are offered the best rates for your particular credit history and financial situation. Now this was all about credit cards. Now let's start to budget. So how to create a budget? Creating a budget is one of the simplest and most effective ways to control your spending, saving and investing. You cannot begin to improve your financial health if you don't know where your money is going. So start tracking your expenses against your income, then set clear goals. One budget template that helps individuals reach their goals, manage their money and save for emergencies and retirement is the 50-20-30 budgeting rule. Spending 50% on the needs, 20% on the saving and 30% on the wants. This one is my favorite. Some might wonder, how do I create a budget? Budgeting starts with tracking how much money you receive every month minus how much money you spend every month. You can do this in an Excel sheet, either on the paper or in the budgeting app as well. It's up to you. However, you can track your budget clearly, laying out the following things. Number 1 will be income. List all sources of money that you receive in a month with the amount. They can include paychecks, investment income, settlements and money that you make from jobs or other projects such as selling craft. Number 2 is to follow the expenses. List every purchase that you make in a month is split into 2 categories, fixed expenses and discretionary spending. If you cannot remember where you are spending money, review your bank statement, credit statement and brokerage account. Fixed expenses are the purchases that you must make every month. Their amount do not change every month and are considered essential. They include rent, mortgage payment, loan payment and utilities. Discretionary spending is the category of non-essential or varying purchases for things like restaurant, meals, shoppings, clothes and travel. Consider them wants rather than needs. Now savings. Record the amount of money that you are able to save each month, whether it's in cash deposited into the bank account or money that you add to the investment account or retirement account. Now that you have a clear picture of money coming in, money going out and money saved, you can identify which expenses you can cut back on if necessary. Subtract your expenses from your total income to get the amount of money you have left at the end of the month if you don't already have one. Put your extra money into an emergency fund until you have saved 3 to 6 months worth of expenses in case of a job loss or other emergencies. Do not use this money for discretionary spending. The key is to keep it safe and grow it for more times when your income decreases or stops. Let's discuss now about starting investing. How to start investing? If you are ready to start investing, you will want to learn the basics of where and how to invest your money. Decide what to invest in and how much to invest in by understanding the risk and potential rewards of different types of investments. Before investing, you must understand what is the stock market. The stock market refers to the collection of market and exchanges where stock buying and selling take place. The term stock market and stock exchanges are used interchangeably, and even though it is called a stock market, other financial securities such as ETFs, exchange traded funds, corporate bonds and derivative based on stocks, commodities, currencies and bonds also traded in the stock. There are multiple stock trading venues. The leading stock exchanges in the United States include NYSE, which is known as New York Stock Exchange, NASDAQ, Kobe Options Exchange. As in India, we have Bombay Stock Exchange and National Stock Exchange. The basic question arises now, how do I invest? To buy stocks, you need to use a broker. This is a professional person or a digital platform whose job is to handle the transactions for you. For new investors, there are 3 basic categories of brokers. Number 1, a full service broker who manages your investment transactions and provides advice for a fee. Number 2 is an online broker that executes your transactions and provides advice depending on how much you have invested. Number 3 can be a robo-advisor that executes your trades and can pick investments for you. Now might be the question arise, what should I invest in? There is no right answer for everyone. Which securities you buy, how much you buy will depend on the amount of money that you have and it is available for investing, and how much risk you are trying to take on the hopes of earning a high return. I will be mentioning some of the most common securities to invest in order of descending order of risk. Number 1 is stocks. A stock, also known as shares or equity, is a type of investment that signifies partial ownership in the issuing company. This entitles the stockholders to take proportion of the corporation assets and earning. Essentially, it's like owning a small piece of company. Owning stock gives you the right to vote in shareholders meeting, receive dividends which come from the company profit if and where they are distributed, and sell your shares to somebody else. The price of the stock fluctuates throughout the day and can depend on many factors, including the company's performance, the domestic economy, the global economy, the day's news, and many much things. Stocks can rise in value, fall in value, or even become worthless, making them more volatile and potentially riskier than many other types of investments. Next on my list are ETFs. An exchange traded fund or ETF consists of a collection of securities such as stocks that often track on underlying index. Although ETFs can invest in any number of industry sectors or use various strategies. Think of ETF as a pie containing many different securities. When you buy shares of an ETF, you are buying a slice of pie which contains slivers of securities inside. This lets you to purchase many stocks at once with the ease of only making one purchase of the ETF. In many ways, ETFs are similar to mutual funds. However, they are listed on exchanges. ETF shares trade throughout the day just like ordinary stocks. Investing in ETF is considered less riskier than the investing in individual stocks because there are many securities inside the ETF. If some one of those securities fall in value, others may stay steady or rise in value. Next on my list are mutual funds. A mutual fund is a type of investment consisting of a portfolio of stocks, bonds, or other securities. Mutual funds give a smaller individual investor access to diversified, often professionally managed portfolios at a very low price. There are many categories of mutual fund representing in the kinds of securities in which they invest, their investment objectives, and the type of return they seek. Most employer-sponsored retirement plans invest in mutual fund. Investing in shares of a mutual fund is different from investing in shares of a stock because a mutual fund owns many different stocks for other securities instead of just holding one. Unlike stocks or ETF that trade at a varying price throughout the day, mutual fund redemption tend to take place only at the end of the day at whatever share price the fund is worth at that moment. Similar to the ETF, mutual funds are considered less riskier than the stocks because of their diversification. Mutual funds charge annual fees called as expense ratios and in some cases commissions. Next on my list is bonds. Bonds are issued by companies, municipalities, states, and sovereign government to finance projects and operations. When an investor buys a bond, they are effectively lending their money to the bond issuer with the promise of repayment plus interest. A bond's coupon rate is the interest rate that the investor will earn. A bond is referred to as a fixed income instrument because bonds traditionally have paid a fixed interest rate to the investors, although there are some bonds which pay variable interest. Bond prices inversely correlate with the interest rate. When rates go up, bond prices tend to fall and vice versa. Bonds have maturity dates, which are the point in time when the principal amount must be paid back to the investor in full or the issuer will risk default. Bonds are rated by how likely the issuer is to pay you back. High-rated bonds known as investment-grade bonds are viewed as safer and more stable. Such offerings are tied to publicly traded corporations and government entities that boast positive outlooks. Investment-grade bonds receive AAA and BBB ratings from Standard & Poor's. Bonds with high ratings will usually pay lower rates of interest than those with lower rating. Example, treasury bonds are most common AAA-rated bond securities. Lots of people have questions in their mind. Let's answer it one by one. Number 1 on my list is, are banks safe? Most bank accounts in and around the world are safe. Example, in the United States, these are insured by the FDIC, that is Federal Deposit Insurance Corporation, up to certain limits, currently defined as up to at least $250,000 per depositor per FDIC insured bank per ownership category. As very similar in India, it is done by the Reserve Bank of India for up to 5 lakh rupees. If you have a great deal of money to put in the bank, you can make sure that it is all covered by opening multiple accounts. Number 2 on my list is it safe to invest in the stock market? Stocks are inherently risky, some more than others, and you can lose money if the share prices fall. So what is the safest investment? So the answer is treasury securities, including bonds, bills, notes. These all are backed by the government and generally considered the safest investment in the world. However, these kind of investments tend to pay low rate of interest, so investors do face the risk of inflation may erode the purchasing power of their money over time. For your better understanding, here I have made a personal finance video. You may go and